Hey everybody, I hope everyone is doing well and had a good day. This is a brief recap of the Emini 5-minute chart for Thursday, December 5th, 2024. If we look at the daily chart to the bottom left here, we have the context. We have a tight bull channel. And I remember last video I only talked about this here, and it's possible to talk about the context with just these bars, but bigger picture context can also help and give hints. But even if we just stay with this, we see the market is rallying in a tight bull channel, and then we have some acceleration here, and it's already been maybe 10, 12 bars. And so we have to wonder, is this gap, this breakout, a measuring gap or an exhaustion gap? It looks like we have buy climaxes with bad follow through, bull breakout, pause, a gap, which is a bull breakout, a deep pullback, another bull breakout, pause, and it's like that the whole way up. Another one, buy climax, pause. So the market, we're getting consecutive buy climaxes followed by sideways trading. And generally speaking, it's a sign of strength when pullbacks go sideways. Like this one here, we rallied, we went sideways for a couple bars, and then we had a second leg up. But this kind of sideways is not so good. Very deep pullback, overlapping the bull bar. Same here. But the bulls have higher lows, higher highs, and again, it's a tight bull channel. It's a breakout on a higher time frame. So in general, I'm only looking to buy. The problem with that mindset, let me put it this way. There's more of a bullish bias overall in the day. Well, at least on the higher time frames. But when it comes to intraday trading on the 5-minute chart, you have to be open to anything. And it's not so much about what you expect, it's more about what the market gives you. Price is truth, so you can have any expectation you want, but the market is going to show you what the market is going to do. And as a trader, you have to be able to change your mind like the flip of a switch. And with all that said, I was expecting probably bad follow through up here for the bulls going into the day, but that doesn't mean I'm expecting a huge bear trend because the context makes that very unlikely. So I thought the best case for the bears today was probably some sort of trading range day. But I also thought the upside for the bulls would be limited because the risk is getting big for the bulls and the momentum is starting to slow down. But then we had a buy climax and we're getting bad follow through. Here's the 5-minute chart. And I want to keep these mostly brief and talk about big picture things. So we had a tight trading range on the open here. And I'm not at my usual setup today, so the screen is a little bit different. And I'm working in an environment I'm not used to. And I don't even have my mouse pad, so please bear with me with the drawings. But let's back up. Here's what we had on the first 6 bars. The way I saw it, we had a fairly strong bull trend here, but starting to get two-sided trading here, and we have a contracting triangle, which means we have higher lows and we have lower highs. The market is in breakout mode. I thought it was more likely that this would be a bull flag, but because it's a tight trading range and a triangle, it's a lot of two-sided trading. And when the market goes sideways for 15, 20 bars, breakout direction can become more neutral. And with that said, this could be a final flag. So we could get one more bull breakout, but the bull breakout may be the final bull breakout before we enter maybe a bigger or more major trading range. Right now, this trading range is minor. It's probably a bull flag. We haven't been sideways for 20 bars, but we're getting close. So I thought for always in going into the day, probably always in long. And that for the reason of this bull trend, we're holding above the moving average and we'll probably get a retest before any major reversal. This trend line break by the bears is more sideways. It's not very strong. So I thought always in long on the open. And then you get a bar like bar 6, probably better to just exit shorts if you're short for any reason. I think 6 is more of an always in bar, meaning bears short for any reason have to get out above it. And bulls, if they're flat, if they're long, they can buy above 6, they can add to their positions above 6, taking a chance we get the breakout. And that's what we got. So it looks like we had a high probability breakout on 6. Not necessarily high probability, but good momentum. And if you think about that, when you have higher probability, which means the market is going in your direction, the direction of the breakout, bar 6, we had acceleration. High probability cannot have big reward. So if you're buying above bar 6, relatively small risk, reward has to be relatively small because the probability is not so bad. There's probably more than a 50% chance we get the bull breakout in this triangle, and then we got it, but we raced to 1 times the bar range of 6 on 7 in just 1 bar. We could not close above it, and then we had bad follow through on bar 8. The reason bar 8 is a little more important is because bar 7 is the bar breaking above the triangle. 6 is within the triangle, still lots of overlap. So bulls buying here, they might be taking a chance, they might be quick to exit if we don't race up, but I still think bears should get out above 6. We're breaking above the range on bar 7, but you need follow through. So selling into the close of the bar on 7, big tail, that's not great. And then you have a bear bar, so no follow through on bar 8. Remember I said this might be a final flag. This might be an exhaustion gap. It's a bull breakout, but we're more than 20 bars into a bull trend. So you have to entertain the idea that this might be a final flag and the last bull breakout before we enter a trading range. So even though bar 8 is not very strong, I think bulls will probably exit below bar 8, maybe even on the close of bar 8, because bar 8, it was a strong enough bar to get a second leg down. It disappointed bulls who bought the close of 7, and the odds are there are sellers above, and a second leg down is likely, at least a minor one. So maybe leg 1, pullback, leg 2. We might be around a 50% pullback of this rally, but then you get bar 9. Bar 9 is disappointing if you're a bull. It's a great bar for the bears, but the context still isn't great. Now we're at support, bottom of a bull channel. The question is this a bull channel still, or are we in a trading range? And are we going to fall below a major higher low? For me, I would consider bar 5 a major higher low because we had a rally to a new high. And it looks like at this point, we're probably going below bar 5. And if we're going below bar 5, we're going below a major higher low. If we're going below a major higher low, the market is no longer in a bull trend. It's either a trading range or a bear trend. So the bulls defend their stops. They buy the close of 9. We rally. But is 10 strong enough to reverse 8 and 9? Probably not. I think 8 and 9 will probably get a second leg down. Reversal attempt looks weak. We had sellers at the breakout point, the bar 8 low. Second leg down likely, and we got it. So at this point, possible expanding triangle, high, higher high, maybe 3 pushes up, and then 2 or 3 legs down, maybe here. So the problem for the bears is this might be an expanding triangle. It's the first big bar below the moving average. In the context, it still isn't great for the bears. It's basically what I was talking about on the daily chart. The bears are now getting a decent trend line break of this bull trend line, but still the best the bears can hope for at this point is probably a trading range, which means traders are buying low and selling high. They're buying sell climaxes. You can see it. Sell climax, bad follow through. Sell climax, bad follow through. Bar 12 is a bear bar, but it's much smaller than bar 11. And that's not great follow through. So consecutive sell climaxes. The bears probably have at least one more push down. These are pretty strong. but after 3 consecutive sell climaxes, probably get a deeper pullback. And that's what we had on 14 and 15. 14, a third sell climax, and then 15, a deeper reversal. 15 strong enough for a second leg up. Buyers below, probably at the 14 close or a new low. Look to the left. We have a bull spike, a pullback, and then a channel. Spike and channel trend. We are testing this start of the channel if you use this one. I was thinking this earlier in the day too. Markets are fractal and it can be tricky to know which the market is going to test, but we had this rally. It's a bull breakout, a pullback, and then we channeled. And so this could be the start of the channel from this breakout, pullback, start of the channel. Market rallied for a couple of legs, but look what happened. We fell straight through this support. We retested it and went lower. So we're probably, the problem for the bulls here is this channel went on for a while. It may have started here, may have started even all the way down here. Bull breakout, pullback, tight channel. So the channel began here, but now we might be testing this one. So we might have to go lower to find buyers. That's the problem for the bulls here right now. Plus the momentum, tight bear channel, technically a breakout, no pullbacks. This will probably get a second leg down. But then again, 15, strong enough bull bar, we may have found the bottom or somewhere near the bottom. We're probably going one tick below 14, but we'll see what the bears can do here. And we've got a lot of overlap. That's disappointing for the bears. Bull breakout 15, a couple of legs sideways to down. This might be a high 2 or a high 3 on a smaller time frame. Odds are we'll bounce here. Doesn't necessarily mean we'll get a major reversal and go all the way up here. I think at a minimum, we'll test the bar 12 high. That's the start of this channel. Bull breakout 11, pullback, implied pullback on 12, and then channel. So I think at a minimum, we'll test the 12 high, and that the 12 high will be resistance. But right now, the bears might be disappointed with their follow through. And when you look to the left, you see a lot of bars going up. You know this bear breakout is within an overall bull channel or trading range. Now we have 3 consecutive sell climaxes and a good bull bar. So you have to wonder if we're near the bottom of the range. 22, bull breakout. Now the problem with 22 is that it might be a second leg trap. We're at resistance, leg 1, pullback, leg 2. Traders are waiting to see what the follow through looks like. But so far, the bulls closed above the prior bars, the moving average, and the high of bar 12, which the bears were hoping would be resistance. So why are the bulls closing above resistance and then getting follow through? You can even see we retested it on 23. Breakout, pullback, testing, resistance. And it looks like bears who sold here, disappointed with their entry bar, exiting at break even, contributing to more buying. Now we have a 3-bar bull micro channel crossing the moving average. Context is pretty good. The rally is beginning at what could be the bottom of a trading range. So the odds are this will get a second leg up, even if it pulls back first. The pullback can be deep because it's a trading range, but for me, when I look at the rally versus the sell-off, my initial thought was that the sell-off was bigger, consisted of more bars, so more price and time control by the bears from bar 8 to 14. But the bull breakout looks more orderly to me. And it's not perfect. The bars are not really uniform in size, but we do have big bull bars closing near their highs, crossing the moving average. And we don't have bear bars or dojis between the bars, like we did here. Bull bar, dojis, big bull bar. So this is more orderly buying to me. And then more follow through, 24. Good for the bulls, but why is 24 smaller than 23? So the big bull bar, 22, smaller bar, smaller bar. This is probably a late leg, a third leg on a smaller time frame chart, parabolic wedge. Might have to retest the breakout point, but the odds are there will be buyers below and a second leg up. We may have to rescue the bulls who bought the close of 7. Bulls buying 7, doing something reasonable, consecutive bull bars, 1 closing near its high, above the moving average. They were trapped with no chance to exit without a loss. But if they used an incredibly wide stop and scaled in, and let's say they bought above a bull bar, like bar 21, second reversal, bull bar closing above its midpoint, you buy the close, buy more lower, the bulls are able to avoid a loss. That will contribute to some selling here, so the odds are we'll pull back. 25, strong enough for a second leg, just want to speed it up a little bit. And then 30 was probably the second leg down for the bears. 1, pull back, 2, even though it's a higher low. The bears failed to get below 26, and then we reversed with a higher low double bottom bull flag. It's within an overall trading range, but bull breakout, high 2, and we rallied on 30. The odds are we're going at least a little bit higher. Bad follow through, another buy climax, but now we're getting to the top of the range. Leg 2 at the top of a trading range, it can be dangerous to buy here. Fortunately for the bulls, it's not as climactic as it could be, but it is fairly climactic. So I think the bulls at this point, the odds are this rally will get another leg up, but because of where we are, the upside could be limited. We might be testing the top of a trading range. We had a bull trend, a trend line break, now we're getting a retest. So far, nothing too appealing to sell. So the bears hoping for a trend line break, retest of the trend's extreme, and a major trend reversal. So far, nothing too appealing. Context is pretty good, but price action not there for selling. So minor reversal here. We got another bull breakout. 40 breaking out to a new high, and then follow through. 41, good for the bulls, but then bad follow through. 42 going sideways for a couple of bars, and then a big bear bar closing on its low. That's really not good for the bulls. Still a minor reversal at this point, but the risk for the bulls is we have to test all the way down here. Bull breakout, pullback, start of the channel, so breakout, pullback, channel. Market cycle, we usually convert from a channel into a trading range. We'll probably come back and test the 36 low, if not all the way down here, or even the bottom of the start of the bull leg. So I think 43 is an always in flip bar. Bulls exit below 43, bears can sell, taking a chance, but they probably still need a double top, some form of a double top, because the rally up is fairly tight. 45 might be that second reversal. We sold off, tried to resume, selling off a second time. And then give up bar 46, bear breakout, crossing the moving average, closing on its low. It's a big bar, and it's also closing below 36, probably going at least a little bit lower because it's an overall trading range. Traders would probably prefer to sell a pullback, but in this case, we sold off immediately. Traders will sell taking a chance, but if we start to hesitate and rally, they'll exit, probably look to sell higher. But in this case, we just plunged straight down. Sell climax, but we're still within the trading range. So as big and strong as this bear breakout looks, the context is actually really bad. There were probably buyers down here. You had bears trapped, hoping for a second leg, 1, pullback, no second leg to a new low, below 14, very deep pullback, and now we're testing an area of support. We're testing where traders got trapped, breakout above 21, the bull bar 22, big gap, and we're testing that area, and look what happened. We're testing support in a trading range, and all of a sudden, the sellers disappear. We test a magnet, and what's the exact magnet? We're never really sure. It could have been the low of the trading range. We didn't quite get there. This is what I mean about support and resistance being more like a field, and it's never a precise one location. It's more of a general field. And so if you're taking a chance, and this probably is not my trading style, but to set a limit order at the 21 high and get filled on bar 47, it'd probably be a mistake to put your stop here. Even here, you probably want it some distance below the possible support. If the market tests down here, your premise is still valid. So a stop in here, if you're buying here, is more of a skunk stop. 48 strong in bull bar, probably will get a second leg up. Bears, they might need a second leg down first. Again, I'm supposed to keep these brief, and I find myself doing bar by bar reviews. We have a contracting triangle. The market went sideways. It's very common after big down, big up. And let me see. Here's the triangle, and we're breaking to the downside. We're trying to break to the downside, retesting the bull trend line, getting a second leg down, bad follow through, still overall trading range. To me, it looks like the bears had a big spike in channel. Bear breakout, deep pullback, channel, several legs down. Maybe double bottom, bear breakout. It's a variation of a wedge. 1, 2, 3. Downside, probably limited, but look at the bear trend line. The bulls have been unable to break out above this. So they try, fail, try, fail, try, fail, try again, fail again, and break out to a new low. But still, it's a channel. Traders are taking profits at swing lows, and they're selling rallies, selling pullbacks. And then we sold off into the close for the final few bars. So when I look back at this day, the most major breakouts I see, we have this leg down, but bad follow through. We have this rally, got a second, a third leg. This sell-off, even though it had a deep pullback, had several attempts down for a second leg, and the bears got their second leg. We got below here, over here. It just took a lot of attempts. The breakout phase is always the strongest part of the trend, the strongest part of the bear trend. The channel phase is it's the second part of the trend. It's leg 2, and it's a channel. It's weaker. We have a lot more two-sided trading. Things are less certain than they are here, but the odds still favor a second leg down. The problem with calling this a bear trend, you have to understand that the bear breakout is still minor. Even though it's big, it's within a trading range. So you're not expecting bear breakout, bear trend, and a tight channel all the way down. It's more of a sell climax to the bottom of a trading range. We bounced, and that's good for the bulls, but you're still going against a bigger and stronger bear breakout. Bulls were trapped up here. They're going to buy lower, hoping to avoid a loss. Let's say a bull got trapped, buying below 45. You're in this channel. You're maybe testing the bull trend line, and then you get 46, 47. Well, if you buy more above a bull bar, 48, you got trapped here, you buy more here. The market gave you a chance to exit at break even on the entire trade. And that's what bulls did. And those bulls selling contribute to the selling. The bears also got trapped out here. If they didn't sell and they weren't quick, they missed the breakout. But the odds were we would get a second leg down, even if there's a deep pullback first. And deep pullbacks are common in trading ranges. We also had a breakout point here. Traders hoping maybe this would be the bottom of the trading range. Spike, pullback, channel evolving into a trading range, but then a little bit too strong by the bears, probably going lower. Bulls buying here, hoping this is the bottom of a range, get trapped, and look where we tested. It's the same area. And then I had a few thoughts today. I'm going to have to cut this video. I don't want to take too long just thinking in silence. But I had some thoughts about system development in general. Sort of the way that I've been doing my work the past maybe week or so. It's been different. I've been approaching my trading work a little bit differently this week. And whenever you do something different than you've normally done it, it's going to be uncomfortable. That's just the way it is for anything. I've mentioned before cold showers. I jokingly say that the water isn't cold, it's just what it feels like. And I say that because I heard somebody showed me a clip of somebody, maybe an entrepreneur, talking about hard work, something like that. And the guy said, it's not hard, it's just what it feels like. And I think about that and it resonates with me, and I think it's really real. I think as humans we make up words to describe feelings, but the words become more real than the feeling. What I mean by that is you have the same chart in front of you, me, Al Brooks. We're all looking at the same chart, but we're also all seeing different things. When you're a trader like Al Brooks and you've looked at charts and thought about charts for 40 years, you're going to see things deeper than someone like me. I've been studying for 5 years, but I've only been really more efficiently studying for 2 or 3 years. It was a really slow start for me. And then you might be a day one beginner, and you know there's no way you're seeing the same things that Al Brooks is seeing, even if you're looking at the same screen, the same chart. So my point with that is, does Al Brooks think, how do I put it? Al Brooks does not sit there at the end of the day upset because trading is so hard and he can't figure it out. It's just what it feels like. And the more you do anything, the easier it gets. It's basically like developing muscle. And there's motor skills involved with trading, so you're really developing muscle memory, you're developing systems for the way you think, you're restricting your thoughts into more systematic trains of thoughts to keep you focused, to keep you looking for the correct things. And there's a whole bunch else that goes into it. You have to understand price action. You need, in my opinion, the Brooks trading course to really start to grasp it. The books are great, but you really will have an easier time grasping the video course, watching the videos over and over. I know I'm getting sidetracked, and the main reason I wanted to say all this is because I'm working on my first membership video, and it's going to be public for everybody as sort of a sample, but I'm still waiting to hear back about legal restrictions, possible copyright, that kind of thing. And I feel bad that it's taken this long to hear back. And I know I have members waiting, and I know they're subscribing to the channel and the membership. And I think it's unfair to not be at least talking about the stuff that I'm going to talk about in those videos. And basically put my own twist on it. Like Al Brooks has his way of doing reviews, Brad, you're going to find different people doing reviews with a little bit of their own twist on it. And a lot of the things I study, the way that I've been teaching myself to study and teach myself to think, is going to be different from everybody else. Everyone's going to have a little bit of a different journey. So with all of that, I said I was doing work a little bit differently this week. What I've been doing, I'm focusing on one signal. So all day I'm looking for just one signal. I'm taking the signal in a repeatable way. It's a process that is repeatable. It doesn't matter what I think is going to happen. It doesn't matter what actually happens.